Welcome to the Real Advisor Podcast. TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear trappers. Welcome back to what many people are calling episode 76 of the Real Advisor Podcast, TRAP Trap. My name is Lick Lincoln. Joining me as ever in the digital studio of doom are the three other horsemen of the apocalypse. Alan, the storyteller Smith, looking tanned and slightly dusty.
Thank you.
Andy, ultra heart, and Carl, the voice, the
looking tanned, slightly dusty.
Hello. Now, gentlemen, we have a show packed full of absolutely nothing. So let's get episode 76 underway with some more high energy review read out by my very good friend, the Right Honourable Mr. Andrew Usain Hart.
Outfit's looking good, Nick, for those watching on YouTube. Okay, so the first review, Chris Hindle, is entitled Irreverent and Insightful. Trap is sharp, irreverent, struggle with that word, and packed with real practitioner value. Expect a mix of insight, industry chat, and unsolicited rants. It's not always tidy, but it's always relevant. The best advisor podcast out there, mainly because it sounds like actual advisors talking and not consultants selling a framework. That is from Chris, who runs the awesome firm Fraser James, with another good friend of mine, James McKay. So, yeah, awesome review. Back to you, boss.
Excellent. We're getting a bit light on reviews, aren't we, Ultra?
No, they're actually coming in quite thick and fast now. So panic is over. Had a good couple of, about 3 or 4 coming in last week. But yep, we're still up for more reviews. We're up to about 222, I think, on the Apple platform. And it really does help with all the ranking stuff. So please do keep them coming. So
okay, so I'll take out the docket then. These are the final reviews. We're apparently up to date. Who's left a review put in by you? I'll get rid of that line, shall I?
Yeah, get rid of that line.
Yeah, okay, good.
Could have done that offline.
There you go, Chris. How tidy is that? Done. Right, okay, topical tidbits. Let's get underway. Let's get this ball rolling. Very exciting topic I'm going to lead off with here. Ultra, contain yourself. I'm not sure if the FCA levies are sent out to all firms this time of year. I tend to get mine this time of year, and I've just got my FCA levy. FCA/FC, whatever it is, FSCS levy. And it's up by 21%.
Keep it coming.
Up by 21% over last year. But this is not a rant, because despite that, my FCA levy is down on what it was, say, 2 to 3 years ago at the height of the sort of pension transfer redress thing. So if you want to just submit your information to us via the survey I put in the IFA forum, there'll be a link to it in the so-called show notes as well. Just be interested to see the feel out there, because we have ability now. We've got so many trappists who like this show. We have the ability to get data from you that might be useful to share with us all as a community thing, because we're all about sharing and not deciding what is interesting or not to put on Trap. So there you go. Right, Smithy.
Are we still talking about levies?
You can do, but we're going to give it punches today. We're not. If we don't need to talk about it, we can go. Ultra might fall asleep. That's the danger.
FCA levy corner. Alan, bring up the vibe.
No, I think this is a worthy conversation, actually.
Oh, wise man.
The as ever, highly efficient Shreen in my team, I asked her in preparation for this conversation how our numbers had moved. I think I shared it with you guys. Yeah, our number for 25 is about the same sort of percentage, I think, Nick, as increase. But looking back, I mean, you were wondering what was happening in 2020 and 2021.
British Steel.
Yeah,
British
so
Steel.
ours is effectively half now what we were paying in 2020. Bit less than half, actually. Yeah, and I think Carl mentioned it as well. What the hell was going on then? But I think that was all to do with the FSCS levy more than it was the FCA regulatory fee thing. And it just shows you, doesn't it, that, and no doubt we did talk about it at the time or afterwards, when this safety net that exists for if people are getting ripped off and then companies closed down, and then so people want to make a complaint and get their complaint upheld, the rest of us have to bail them out. So that was what it was. So when we were paying more than double what we're paying currently to bail out all these mis-selling scandals which are going on at the time. So I guess that's a good sign. The trend is broadly down. It is higher than last year, but anything which, if we're paying half what we were paying, obviously hopefully our revenues have gone up as well over that period. It's a net positive where we are. right now.
Question, Alan.
Yeah.
How is it calculated? Is it based on AUM? Is it based on turnover? Or what are the metrics?
I think that the main basis of it is turnover.
Turnover, yeah.
Yeah, it's a percentage of turnover. So most firms, you would hope or anticipate your turnover is going up every year. So if you've got a pro rata increase year on year, but every now and again you have these godforsaken scandals and things that come out, blow up tens of millions, whatever, to cover the losses for people.
But it was interesting. You did share it on in our group, and like it was the increase based on the scandals. I think it was DB transfers, was it? Was for three full years. So it was a significant hit.
It was a choppy period. But that's a good point you raised there, because our fees have gone up. But I'm sure all four of us have had turnover go up over the last 3 or 4 years. So even if it just went up in line with turnover, the fact that the fees have gone up, my fees have gone up this year by 21%, they're still way lower than they were 2-3 years ago, and on a much bigger turnover. So, take the rough with the smooth, and I can definitely live with that. Okay, moving on, because we're going to be fast-paced and on it today. Storyteller, fund fees.
Yeah, so this was something that I saw in the Citywire magazine, newspaper, whatever it is, online website. And I thought it was worthy of conversation. There's a lot of sort of evolution, ongoing things happening in the advice market, and a lot of sort of PE-backed consolidation going on, and some which is not, just growth of companies. And there's an increasing number of firms which are effectively running their own investment models, investment portfolios, portfolio range, but I mean proper funds, as opposed to just buying model portfolios and putting together like we do, effectively putting together a portfolio of funds ourselves, but not actually running funds.
Proper orgs,
and
unit trusts,
So this was the article revealed the fees advice firms make on their in-house funds, and it gives a big long list. It's a good piece of journalism actually, because it digs down deep into all these different groups, different funds. And they say advisor funds, how much clients pay. And they give a big long list of all these predominantly much larger companies. And it ranges from at the top, the most expensive, funnily enough, a firm I've never heard of. I think they're in Northern Ireland, Doherty PLC, which is 1.63% is the funds. SJP, St. James's Place, in some respects, no surprises, but it's unfair, to be fair to them, to quote them in the same basis, because their fee is 1.61. But as we know, SJP bundle everything together in terms of advice, planning, etc. Whereas I think a lot of the others are purely investment portfolio. Then it goes Fisher Investments at 1.47, Foster de Novo 1.32, and so Greystone, Equilibrium, Lowe's. So these fees, as I say, range from 1.63 at the top. A lot of them congregate around the 1.2, 1%. So this is for pure investment management, where the advisor, so these are not purely discretionary fund managers, these are predominantly advice firms putting together their investment portfolios and charging, about 1% a year.
Right, so, and that doesn't include custodial. I never know with these things.
It's not that clear. It doesn't.
No,
it's not that clear.
Some of them will, some of them won't. But some of them I think is pure advice.
Yeah, but until you know which ones are which, that's quite a big, it's 20 bips, isn't it? Typically 25 bips. It kind of makes the whole thing a bit redundant.
Yeah, I mean, for example, let's take the bottom one, Fairstone at 0.42. There's obviously additional charges for the client versus, let's say, one of the higher ones. So, there needs to be a little bit more.
If you look at the higher ones, let's say Foster de Novo.
I pretty much know all the firms on this list, apart from about 5,
Quite a few I've never heard of, but a lot of them are the PE-backed consolidators, Saltus, Ascot Lloyd, AFH, and I guess that's
Shackleton, Beckett, all on it.
Titan,
Equilibrium, we know them. We know Colin well, good personal friend. Atomos, we know all these.
We know quite a few.
Thank you, Nick.
Andy, the ultra crepidarian Andy. He knows about everything, Andy. Can't be told anything. His name is Andrew Hart. Andrew Hart!
Not only does he know about everything,
nobody knows more about in-house funds than me.
He knows
the greatest.
Everyone. He doesn't know.
They're
just
high,
everything.
but they're good. They're high, but they're good. Nobody knows more about in-house funds than me.
I've got a couple of things to share today, and it is about fees in general. But if you look, just ballpark, and it's not all about the cheapest wins, etc. But there is a high correlation between higher fees and lower relative performance. We know that. It's a statement of fact. Our portfolios are about 20 something basis points. And so some of these firms are on average 4 times as high as are the portfolios that we run, which, as we know, are predominantly low cost index with some factor tilts, etc., built into them. And I don't see, however, how over any meaningful period of time, these other companies are going to compete. Or you've got to have a hell of an outperformance year on year.
The hurdle rate's a lot higher.
The hurdle rate is just crazy. If it's a 4 to 5x just on the pure cost, you're going to have to be some sort of investment genius. It doesn't exist.
I'm going to be brutal. Carl, your hand's raised.
Yeah.
Yeah, question on that. Are some of the consolidators in there? Because
yes.
Yeah, because I know that some of the consolidators were buying up firms and then saying, oh, by the way, you've to move to our platform and to our funds. And, you know, if they're buying firms and then insisting the clients move on to their own platform and their own funds, well, then they're in a position probably to pay a little bit more to the firm that they're buying because they are in a break-even scenario much, much quicker.
Well, that's exactly right. That's
the bulk of the firms in this list, Carl, are acquisitive. They're acquiring firms one way or another.
Yeah. You're right, and that's part of their business model. You roll the client portfolios into their funds. They take a slice of that.
Yeah, just more clips to the ticket. Rinse and repeat.
How can firms who, like ourselves, who extol the virtues of index investing, then decide, oh, well, I'm going to get a shitload of money to sell my firm, and all my clients who I told a story to over 2 decades or more, I'm just going to change that story.
Because incentives drives behaviour. When there's a massive check, people change their values. Rinse and repeat.
We actually had this conversation in our own group during the week about something else entirely. You're entitled to change your mind. You're not entitled to change your values.
Many people change their values.
we don't know a lot of these consolidators. We don't know if they're not buying purely full fat financial planning firms that focus on capturing market premium.
I think that's probably part of the story, Nick, is they're buying more traditional IFA firms that are maybe outsourcing to the wealth managers and still pay, and maybe the fees are broadly the same. The difference is these now retain some of the revenue share. But that would be a dilemma.
But looking at the ones at the higher end here, if there's custodian fees on top and advisor fees on top, then my lord.
Yeah,
they're going to be in for a 2.5-3%, which we know is not the case for some of these firms that I'm looking at. But interesting article nonetheless.
Okay, good. Yeah, good stuff. Okay, talking of taking things and clipping their little share, ESG in Ireland, Wodge.
Yeah, I just thought this was interesting. So Davy set up a division called Davy Horizons when I suppose ESG was beginning to emerge as an option for investors. Now, look. It should be said here that people have lost their jobs, so they've axed the entire division. So obviously that's a bad news story. Now, I think some of the people who were in the division, I don't think there was that many people. I think some have been redeployed within the Davy group. But look, it's just more evidence, if we needed it, that this ESG investment story is it's gone from boom to bust, hasn't it? I think the big one of the death knells for this was when the EU changed this Article 9 and Article 8, what qualified as Article 9 and Article 8, because they were all saying, oh yeah, our fund is Article 9. And then the EU said, well, if it doesn't do this, and this, and then like tons and tons of funds had to drop back to Article 8 and basically go to their clients and say, yes, sorry about that, we're actually not Article 8. So look, probably a bad news story in terms of, you never like to see divisions that were set up with really good intentions being axed, but I think it's more evidence, not that we needed it, we probably knew this intuitively anyway, that the ESG investing bubble has definitely burst.
Yeah, there's no question. When you had, we've talked about this in the past, haven't we? There was a lot of bandwagon jumping, wasn't there? I remember I raised it. I think I'm right in saying that Aberdeen, for example, just reclassified a whole range of their funds and put a name, just put sustainable or something in front. Didn't change any of the underlying holdings.
The cynicism, cynicism.
And that was one example.
Exactly.
They must have thought it was jackpot. They must have looked at the rules and realised, these funds qualify. We don't need to do any work. Brilliant. Boom, off we go.
We hold a fund within our portfolio, which I think it was an iShares. It's a REIT fund, and again, all of a sudden, overnight, it was just called, and it was I can't remember it, but some long-winded thing.
Global sustainable. They threw those two words in.
Just global sustainable, and just exactly. And we thought, and honestly, we actually had some clients saying, I don't want that. I don't want global sustainable. I just want a normal fund, please. Because
there are some clients for sure who have an interest in this, and if there was real solutions, they would invest in them. I had a client only last week, or maybe it was the week before, but very recently, ask about something along these lines. Right, it was more to do with
avoiding companies,
geopolitical issues and defense, and blah blah blah. Right, so there is an appetite for it, but thankfully there are some rules and regs now around what you can call various sustainable or they're anti-greenwashing measures, shall we say. And that's good, because I think a lot of the fund managers were using it as this is a marketing tool. Let's go all in on this. Because
not fund managers playing to the rules. Yeah. It just doesn't sound like our business.
Get ready with the drop, because the most famous of all was BlackRock. Remember? They were huge into ESG.
How's that sponsorship deal going with BlackRock? It's still very quiet, isn't it?
It's cancelled, like a lot of other things.
Well, they just switched from ESG to crypto, didn't they?
But they have got a load of Bitcoin. They have got a load of awesome funds that do create great wealth for very low fees. They're just huge. It's an issue of scale with them, obviously, isn't it? What are they at the moment? 11 trillion. Still a huge chunk of their assets are in the right place.
You can still have a nice range of low-cost funds that create value, and they're not mutually exclusive.
They've got a load of.
That's a very fair point, Andy. They absolutely do, and they're probably leading the market in a lot of those.
They're a very innovative company.
Right.
They do get involved in a lot of stuff.
Yeah, the thing is, without overdoing this, the whole ESG thing, I think we've been fairly consistent on this since we started this podcast, is it was always just full of conflicts and challenges. And you say, well, I remember the one that really stuck out to me years ago was that Meta, or Facebook was always one of the top holds for these ESG portfolios.
A lot of the tech firms were, Microsoft as well.
Yeah, I've just got this pathological dislike and distrust of all things to do with Facebook and Meta, how they manipulate people, data, everything, and the damage they've caused through
live on bloody WhatsApp. You should vote with your behaviour.
No, but I don't.
Why don't you go to Signal?
But I don't live on Instagram and
but you live on WhatsApp.
Facebook. I message people on WhatsApp. That's true. Tried to get you guys to move to Signal, but no one was interested.
Come on, you can't get away from Zuck.
That was just an example of something which was full of inherent conflict. And to say, well, I'm buying those because it's ESG because they've ticked a few. I think a lot of these big companies knew how to game the system as well.
Exactly.
They found out what the rules were.
Exactly.
So we do all these things, and so therefore we should be included in portfolios. And so it was just rife with difficulty. I agree with you, Carl. There are sound reasons why people would wish to avoid certain types of industries or companies or invest in some. But I don't think this greenwashing of an entire industry, which effectively did happen to a large extent, I don't think it helps anyone.
The asset management industry loves anything new. So new money can pile in, new things they can sell. It's a marketing business, not a finance business.
Exactly right.
Okay. Yep. Right, let's move this on to a recurring theme. FNZ. FNZ this week had their debt downgraded by the rating agency Fitch. Now, I know we think rating agencies really are a pile of poo, but let's put that to one side, pretend what they did was valid. Fitch downgraded FNZ's corporate debt, to B-, which means Fitch thinks it carries a risk of default. And again, as we said in episode 74, FNZ are a big player in the platform market in the UK and other parts of the world, I think, and they write the software that underpins Aberdeen, Quilter, and others. So again, I would just be nervous, very nervous, if I had my business was built around one or two platforms and if FNZ were connected to any of them presently, because it doesn't seem like a good news story. And we'll just quickly dovetail onto that. Andrew, you've got a very, very interesting story related to FNZ.
Yeah, it's also incredibly dull, but about FNZ again. So it's another.
Is it FNZ or FNZ, as Nick just alluded to.
I think it's FNZ, but
I said
Yeah,
FNZ, didn't I?
they're originally in New Zealand, aren't they?
Nick is dressed like a Canadian teenager, so he can speak Canadian today.
Well, they're from New Zealand. Anyway, keep on.
You said Z.
What? Jesus Christ.
I know.
Anyway, so another bad news story coming from SNZ. They're hit with a 4.6 billion class action lawsuit from employee shareholders. FNZ have raised a load of capital due to recent events that are happening, and the existing shareholders are going to be diluted heavily. And if they raise more capital, the existing original employee founders might end up with zero equity in the company. So there's another lawsuit. Also, there's this new lawsuit that's bubbling in the background. Just more bad news for FNZ. Back to your point, Nick, you have raised this, and it did get me thinking quite long and hard, because you've got two companies you're dealing with. The company that you think the money's with, whatever the platform's called, and then the back-end tech. People like Hargreaves, people like Fundment, people like Transact own their own tech. That's why I believe, my personal opinion, that's where you want your money to be.
Yeah.
But I'm pretty sure all of this money is massively ring-fenced elsewhere. So even if FNZ does go belly up, it won't be pretty. But I'm pretty sure some other.
That's not the problem.
No. I'm just.
That's not an issue.
Advisors listening, and maybe end clients listening, thinking like money's going to go pop.
No.
I think there'll be safeguard in place.
FNZ are definitely definitely one of these too large to fail companies. They would be in the
hopefully they don't, and they can get their act together. But I'm sure there'll be someone that'll be able to save them, do the right thing.
Can I say a point on this? First of all, it shows you some of the corporate shenanigans that go on once they take external investment, and you've got investors looking for preference shares or whatever it is to get certain returns that they must receive, and that leads to dilution of other shareholders and so on and so on. That's what's got a real issue going on for them there.
Well, I think the founding shareholders are going to be wiped out here. Like that's what you call a suboptimal outcome for sure.
You wonder why they're pushing it.
Sorry about that, lads.
Yeah, their paper fortunes were enormous, and then all of a sudden 2 raises, accounting shenanigans, and before you know it.
But the thing is, they haven't done anything illegal.
No.
And so whoever was, analyzing those fundraisers.
Well, they're taking it. They're suing them, so they clearly think that they have.
Yeah, maybe they
illegal,
felt they were misled.
That's remains
the other
to be
thing, and it's a huge subject. I remember some years ago. Shout out to my colleague Charles. Some of you guys know him, Charles Richards. He did a project. Because there was a time when people were getting increasingly worried about some of these platforms, and the real kind of what happens if, let's say FNZ or whoever goes under, because it's still all in living memory. We had mainstream banks facing bankruptcy effectively in the UK and around the world, and it is impossible to find out. Let's just say if you own, let's say, a dimensional fund held on for example an Aberdeen platform, but some of the money is in cash and it's on the platform. He spent a long time trying to find it out, and in the end, there was no satisfactory answer
with
for
State Street.
So they've got
Switzerland.
They've got custodians. They've got depositories. It depends what asset class it is, and some is in
like
Dublin.
9 levels of mess.
Yeah, it's a mess. And you try to get the answer to it. There was we had to just say, all right,
just
fingers
project.
crossed, it's going to be
but ultimately, you're able to tell your clients that you are in a segregated account. So I think that was one of the
but that's what they tell you, Carl. But it's like, okay, then here's a PDF that's 800 pages long, and there's another PDF that's 900 pages long.
Yeah.
Hold on. So that was one of the outcomes of the financial crisis, was that when Lehman Brothers went under, they had no segregated accounts. So people had to go, here, hold on, I had 200 grand in there, and they were like, oh, hold on, we'll have to try and trace that back. So that was one of the outcomes of the financial crisis, was that all similar type platforms had to have segregated accounts.
Right.
So
they tell us,
Yeah, but right. But also, you're assuming, because what they do, they have new money comes in every day, and at the close of every business day, it's swept into the custodian separate account. But sometimes their systems fail, and it doesn't get swept in, and it sits on as a balance sheet asset in the event of a bankruptcy. That money's I would think at this level. I mean, we're
then
not.
You're only going to try and trace one transaction,
maybe,
right? As opposed to
Maybe. I mean, we just hope we never have to and
No,
expose
look,
us
I'm not
to these things.
underestimating that if an FNZ or somebody similar went under, would it be a total another shit show and a mess? Of course it would. And would it be
but
torture?
hopefully, all said and done.
They're
Yeah.
not balance sheet assets
Nobody
of FNZ.
on
Yeah.
nobody on
find a
Main
new-
Street
a
would
new
have lost their
administrator.
money.
Yeah.
Which we kind of said 5 minutes ago. Right. just, I'm sure the Trappists, and even some of the more sentient members of the Trap Pack, of which there are very few, I'm sure the Trappists are wondering, how did Nick know that we mentioned FNZ in episode 74 prior? Well, the reason for that is, dear Trappists, that we have extensive show notes for the backlog of Trap episodes, going back as far as episode 53. They're all on one master Google document. So rather than having each podcast with a long list of notes, they're all aggregated in one document. So I opened that up and simply searched for FNZ, and there it was. So if we're building up a little library here with our show notes. If there's anything you want to see we've talked about in the past, open up that document. There's a link to it in the show notes. Open the document up and search whatever it is you think we might have discussed. And it'll bring up every episode where we discussed it.
No,
So
on a serious note, Nick,
that is serious.
On a serious note, that's an amazing document. As I say, every single episode is going to be there, so it's going to be a treasure trove of information for advisors. Is that easy for people to find, Nick? Because knowing you, it's probably some obscure link that is some secret code.
Once again, for the slower brains, there's a link to it in the show called show notes.
Okay, so you've got to be on the podcast. Why don't we have therealadvisorpodcast.com/show notes and it be there? Anyway, we'll sort it out some other time.
I must
dear
check
listeners.
it out sometime. It sounds awesome.
Carl can't even find the fucking show notes. And he's on the
Carl's never
show.
looks, and I've got faith in Carl that if he did try and find it, he probably would if he got some of his team involved.
Nick,
All right.
has it got the full transcriptions?
Well, I'm coming on to that.
checked it either.
Alan, I'm coming on to that. If you looked at the agenda, you said the next point is I'm coming on to that. In the last couple of weeks on the LinkedIn Trap site, I think somebody said, can we have a transcript for each show? Trappists, since day one, since episode 1, there is a full transcript provided that should be in your app of choice, your podcast app of choice. There is if not, go to the Buzzsprout website.
Somebody wants to read it. Someone wants to read it.
Somebody wants to read it.
Oh my God.
Someone did.
There's 75 episodes out there in the interweb of all of our garbled nonsense transcribed.
Brilliant.
And
what you can do, therefore, you can take that off the Google Doc or the platform thing and plug it into ChatGPT or similar and ask it to do a search for you. Yep. And that, to be fair, that is because all of us get quite regular. No, there's no real problem with it, but we often get asked direct messages and stuff, LinkedIn,
repetitive
etc.
questions of things that should already be
guys,
out there.
Can you give me an? And we've already had a whole episode on it, and people say, "Which episode?" I say, "I don't know."
Yeah, but we could have a link on the website, Nick, therealadvisorpodcast.com.
Yeah.
So we'll build out the website at some point.
Have we a website? That's a serious question.
Don't get me started.
Holy crap. Right, let's move on, boys. 28
That's
minutes.
That's why Carl's on 10%.
28
40, 30, 20, 10.
Right, shut up. Right, storyteller, Y-Tree Wealth Management. Oh, Christ almighty. Go on, make it interesting.
No, I believe this is good. So back to the theme of fees, charges, transparency. I think it's something we have to keep banging a drum about because it's something the industry still, despite all the regulation, fails to do particularly well. There is a company, I have to do full disclosure so I don't get front page news of Citywire New Model Advisor. I'm an investor in this company. They're called Y-Tree, the letter Y, and then here we go. God.
Should do.
Did you cut that off early, Nick? It was dragging on a
But
bit.
now I'll just bring it back to annoy you.
Yeah, thank you. So Y-Tree, and I've known the guys there since they started the business, and this is a classic business whereby the CEO and co-founder Stuart Cash, he's super smart guy, ex-partner at Goldman Sachs, and when he was looking for advice when he was making a lot of money, he felt always a bit dissatisfied with the wealth management industry. So in pure entrepreneurial spirit, he started his own business, him and a few others. So they've got this company called Y-Tree. And so it's a very high-end, ultra-high net worth wealth management financial planning company, very data-driven, very digital, and really embrace this kind of, it's like a high-end version of what we do. It's proper.
Are they capital competitors? What's going on here?
We're kind of fishing in slightly different ponds, but no, they do similar to all of us. They do it so they built their own cash flow. So they do proper cash flow models, but for super wealthy people. And they've got they predominantly invest in, again, they built their own models, but very low cost, predominantly index funds, etc. So they're a really good company, worth checking out. But they have just produced a report And it's because they've done a big deep dive analysis. They can tell all on their clients. So their clients often are dealing with, the advice comes from JP Morgan, Private Wealth, Credit Suisse, all those sort of companies. They've done a lot of analysis on fees and charges and costs and compared it to investment returns. So they've just published a brand new report. And the headline is this, and it's not going to be a surprise to anyone, but 94.1% of UK wealth managers underperform, according to the new review, and a lot of other data in there. They've done a deep dive analysis. So here's my point. I don't think that's news to anyone. I think that when a lot of advisors go against the likes of St. James's Place and some others, and even some of the conversations we have here, to use Ultra's phrase, the guns are pointing in the wrong direction. Because these other organizations, these competitors, sort of high-end, high-net-worth wealth management firms, fundamentally, they do not do financial planning. They deliver really expensive, underperforming investment portfolio management. That's all they do. So Whitetree are kind of exposing that. They share the same philosophies as we all do, and many of the listeners to this podcast. And it's quite an interesting deep dive. And I think of all the sectors of our industry, that's the one that deserves more disruption than the others who might be doing proper financial planning, might be a bit more expensive than you can get elsewhere. But if you're not embracing full fat financial planning and you're just charging an arm and a leg to run investment portfolio's, there should be more of these analysis, more of these reports.
Ever since I've been in this business 20 years, these reports have been coming out. And the flow of money towards these ultra expensive, ultra exclusive discretionary fund managers, for example, has not slowed down. People love the status purchase. There's cheaper handbags than Louis Vuitton all over the world. People are still going to spend
but Louis Vuitton is really good quality, though. That's the difference.
Someone in the handbag game would argue that it's not, and the one down the road for 400 quid's better. The status purchase is human nature, and good luck fighting against it.
I wouldn't that's a fair point, Andy. You're at nothing trying to fight against it, because the ultra high net worth, the ultra high net worth clients, we've got a few. I'm sure you do too. Like, they want something sexier. They want something different. They like their financial plan. They like having their family fortress money, right? And they'll index funds that all day long. But they want more. And if you're not willing to give it to them, they will go elsewhere. And that's just the way it is, because they want something different, and a lot of them are looking maybe for potentially a purpose in their life, and part of that purpose is to be looking at their investment portfolio and dabbling in lots of things and keeping their brain ticking over. So I think it's worth don't dismiss it, is what I would say. Nick.
There was a little nugget revealed in there, because my philosophy is you don't necessarily, and maybe for the younger trappists who are going out their own or thinking about it, is ultra high net worth can be a pain in the arse, and they will expect some pandering to. And I think we've built a very good business by going for mass affluent, people who just don't know if they've got enough. Just throwing that out there, okay? I'm not saying turn away ultra high net worth, but they do come with their own conceptions about what you were going to give them in terms of service and so forth, and it's not something that
huge expectations of monthly reports and all that kind of stuff.
Which is fine if you want.
You've absolutely nailed it there, Nick. Like, if you're setting out, and don't chase that ultra high net worth, because you're probably not going to get it if you're only setting out.
Wasted time with inexperienced advisors chasing that random client they've got from a third friend of a contact that's got 50 million, and they have 15 meetings, send them 1 million reports. They spend half a year doing it, and in the end they say, oh no, we're going with HSBC Private, they charge 5%, but I love their offices. Thanks guys. I mean, just forget it. They give me
tickets to Wimbledon.
I know the moment any inexperienced I'm chasing this client, I just fucking move on, mate. Go for the mass affluent, the high net worth. We work really well with slightly clued up insiders. Slightly clued up insiders, they've got a lot of wealth. They understand that they're expensive, they're cheap. They understand that Barclays Wealth and Maven Advisor can access the same funds. They're the people that you want to focus on, the slightly clued up insiders, I call it. That's it, Brad.
I don't see this hand thing up. This working well.
I was going to back you up. Did Andy raise his hand there before that interjection? I don't think he did.
For those of you who are listening or watching,
I've got a yellow card.
We've got a system hand raising, digital hand raising, but Andy seems to have forgotten it.
Anyway,
so I was going to just say,
as Charlie Munger says, put it in
for
the
the
too
love
hard
of
bucket.
God.
It's the too hard bucket. It's not for you. I mean, me and Alan talk about it all the time. Alan and I, these large DFMs in London, this is what they do, bread and butter, day in, day out. They just swallow up all these, what do they call them? Sophisticated investors. It means a rich idiot. Sophisticated investor means a rich idiot. They swallow up these sophisticated investors all day long. There's no chance.
Right, Alan, your hand is raised,
Little Old
please.
Chicken Shed.
Thank you. When I went to the US a few years ago, when I went with Dimensional, I went to their HQ, and they took us out and introduced us to a bunch of different RIAs, as they're called, over there, and we flew into Dallas, Texas, and we met this firm, and they were, Dallas and Texas being an oil-rich place, and they said, and they were a firm of CPAs, they were accountants as well as advisors. And they were telling us all about their business model and what they did. And there's a lot of interesting things that came from it. But I always remember that they said, look, we deal with some clients who are literally billionaires. And we also deal with what they called mom and pop clients. And their mom and pop client was $1 million client that they charge 1% a year, full fat financial planning, dimensional funds, etc. And because they're an accounting firm, they're very, very smart, and they're very focused on their profitability per client. They said those clients are by orders of magnitude more profitable. They come in for one annual meeting. They're grateful that we meet with them. Whereas the billionaire clients, they want to meet monthly. They've got an army of lawyers and tax advisors, etc., all coming in. He said they pay a lot of. They
splitting accounts everywhere.
They pay big fees, but when you analyze the work and the effort and the risk, then he said my advice to you guys at the time is look for those $1 million clients and offer them a fantastic service, and that always stuck with me.
Yeah,
I thought that's quite interesting.
Okay.
It's a good sweet spot.
That was well worth waiting for, Mr. Smith. Now you can lower your hand, please.
Right.
Thank you.
Thank you.
Okay, moving on.
I don't do that. I'm going to keep it up permanently.
Well, that's between you and Mrs. S. Right, let's go on to Andy.
It's descending into mayhem.
They have just been on holiday, so careful, everybody. My next point is Nick, Valid Path.
Yes.
Okay, so Valid Path are a new-ish network in the UK. We know a lot of good firms that are part of them, and they launched a client buyout program, CBO they're calling it. So Valid Path will fund existing Valid Path members to buy out retiring Valid Path members.
Valid Path or Valid Path?
Valid.
Yeah, he just keeps in Valley.
Oh, sorry, Valid Path.
Jesus.
So the buyers. So this is the challenge for the independent sector in terms of getting funding to acquire firms and grow your business.
Yeah.
SJP have got a whole internal system that works very well, usually, but there are obviously exceptions apply.
There's a dude on LinkedIn doesn't think so. He thinks it's a terrible idea.
Of course. We have somewhat of an option in outside of the network structure. What's the name of the firm, Alan, that funds it? Vertis do a lot of funding.
Transact,
for this. They also do non-transact firms as well. They've obviously got
Vertis may be pulling back now. That's a whole other story, not for right now.
Move on.
But,
Anyway, so Valid Path, the network, have set up this mechanism to provide funding for Valid Path members to buy other Valid Path member firms, but also external firms. So I think it's any innovation that can grow the businesses of decent full fat financial planning firms, which is most of the Valid Path members. I'm pro it. So that's that really. And we need more innovation in this space. Vertis are the only player in the game, I think, and they charge something like, I'm going to get it wrong, but a big margin above base. So it is quite a sort of, a heavy burden on the firms that are using their funding. But obviously, if you don't want to take my funding, then you don't have to take it. But hopefully there'll be
there's a limited range of providers.
Range of providers. Yeah, we need a bit more innovation in this space.
Interesting.
But as we know, the fund management business is quite sticky revenue and quite known revenue. So funders should be all over this space. So that's that.
Question then on that, throw this open to the floor. If you were setting up on your own, would you consider buying a firm and doing it that way, because we've lots of younger listeners who are sending us all messages all the time about how will I do it and how would I set up and how will I get my clients. It doesn't seem to be something that's talked about a lot, as will I just buy this firm and maybe buy a smaller firm, but at least have a few clients. So I think it's a good idea. Would be my call.
Yeah, I would.
Sorry, my hand's raised, Alan. You probably not look. Yellow card. Great question, Carl. I can answer it personally because I looked at this. So I spoke to a lot of Basically, I didn't have the money to contend with the big players. So when I was 35, thinking about setting up Maven Advisor, I had 3 or 4 meetings with the retiring advisors that Nick and Alan probably know. We sat down, they're 65, they said, Andy, this is my revenue, this is my client, give me all the metrics, I need this to buy it. There's no chance I could get that funded. And then someone else came along that was a consolidator that was not doing it in the right way, I would say, but they offered them 5 or 6 times. They offered them twice what I could have even attempted to raise.
Yeah, but sorry, was this other crowd that you're not talking about offering funding for people who are going to buy other firms? No, did I misunderstand?
So let's just take the Valid Path as an example. I would set up a new firm with Valid Path as a Valid Path member of that network. They would then say, Andy, we've got this funding mechanism. Alan's retiring. Do you want to buy his book? We've got the value. You've now got a huge debt on your business, right? I would do it all day long, Carl, all day long.
Yeah, that's what I'm saying, yeah.
Because SJP do it, and again, I could be getting the details wrong, but long story short, they don't require a personal guarantee of the person acquiring. So if I did something with Virtus, I'm assuming they would want my entire life, my mum's life, my cousin's farm, like everything on the line. Whereas SJP, and I'm thinking Valid Path, won't require a personal guarantee. I mean, a personal guarantee is not the end of the world because you're backing yourself. But if you can buy a business without a personal guarantee and take a huge loan out, and it's secured on thin air, I say thin air, it's secured on the clients
over a long term.
Over a long time, I do it all day long. There's a lot of people I know that I do quite a lot of work with, younger advisors that are, let's say, 35, Carl, and they've got a 20 grand a month loan repayment coming out of their business. Keep it simple. It's bringing in 35. 20 goes to the loan repayment, 15 covers the business operating. But yes, I would do it. And those advisors know the exact month when that 20 grand stops. Yeah. It stops in 5 years and 3 months. And when that stops, they are
gravy train
in the money, let's say. So I would just be aggressively acquiring businesses if I had the mechanism to do it without having the personal guarantee.
Okay.
Or Nick?
No.
Okay.
Alan?
Yeah, I'd agree with you. In terms of the personal guarantees, and I know a bit about this, you hopefully would avoid personal guarantees. They take what they call a debenture over the firm. So if you default, they'll take that client revenue, which is fine, reasonable. That's fair enough. But the main thing is they won't come and take your family house or anything like that. So it is like all these things. Is guess what? Back to this thing called risk and reward. You can start by yourself, one client at a time. Build up slowly but surely. It will take you get there, but it'll take you years and years and years to have a thriving, successful practice. Or you just go in deep. You've got 100 clients day one, but you've got a lot of debt to service. Usually the break even is 6 to 8 years, depending on the funding rate, what you bought, the multiple, etc. If you're playing the long game, if you are relatively young, I think you say, look, 6 years from now, 7 years from now, we'll be free and clear, provided we look after these clients, no one leaves us, and very few of them die. It's down to, but that's true, Nick, because
I'm not saying it's not true.
You're buying a book of clients, and if their average age is 78 or something, you're going to get an attrition rate because of that.
I set up. I did it one client at a time myself. I literally set up with nothing, and Christ, lads, that first few years was
painful.
It was torture mentally. It was. Oh my God, I don't know if I'd do that again.
Are your mum and dad still clients?
So unfortunately, they went into one of the geared property funds.
Not the solar wind farm thing, no? Okay.
No, right, Jesus Christ, there's news on that lately. Oh my God. Anyway, I won't. Don't suck me in on that.
We've touched upon this before, but again, I'm just going to mention it again. I think you boys do various surveys every year, but typically an established financial advice wealth management business doubles in size every 5 years. So if you're a 50-year-old,
Well, in terms of turnover.
yes, turnover and assets double in size
Right.
every 5 years. It's the rule of 72. 72 divided by 50. A typical financial advice firm, wealth management firm, has got three forces. It's got new clients coming in, it's got new contributions going in, it's got market returns. And typically, they average 15% a year. You divide 72 by 15, it's 5. A wealth management financial advice business should double every 5 years. The challenge for older advisors, they're 55, their business is worth X. If they just stick it till they're 60, it will double in those 5 years.
Those
If your business is not growing by 15% a year in the wealth management business based on new clients, contributions, and investment returns, you're doing the wrong thing. So based on
your numbers are absolutely 100% spot on.
Thank you, Carl. I've done a lot of research into this recently. So
hang on. So based on what? Because the evidence that comes out, the research is most advised. If you strip out market returns,
I didn't say strip out market returns. I said three forces: new clients, new contributions, investment returns.
That's fair. He did say.
Yeah, but very few firms are growing at 15% compound. Very few.
They have to be. What are they doing?
Are you?
Of course I am.
I'm not.
Right.
I'm looking at my figures from 2019-20 compared to 24-25,
Well,
and I'm not.
And the other thing, and it's a huge other subject, just the aforementioned mom and pop classic clients in retirement, and particularly with the IHT rules, they're withdrawing. So you've got that. So that you've got that against you.
Absolutely.
That's an age demographic thing. Yeah, that's
that's
an
what
average
most
age of
advisors play. So if you think your net of withdrawals and spending and gifting, you're still growing at 15% compound and you're doubling in 5 years.
Yes.
Well, I'd like to see
I sit down with retirement advisors and build their own financial plans, as you well know. This is the thing I do a lot of. And when I sit down with them and they say, Andy, these are the numbers I'm looking after now. And I'll say, what were you doing 5 years ago? Half. What were you doing 5 years before that?
Market's doubled. Yeah, fine. Based on
new clients, contributions, and investment returns.
Okay, can we save this for the new Rule of 72 podcast that's being launched next week? Listen, we're at bloody 47 minutes. We've still got 7 items on the agenda. So can we just crack on and be on it?
Yes.
Lodge, Riley Moynes. If I've said that wrong, I apologise. Irish names give me the
Dr.
heebie-jeebies.
Riley Moynes. Okay, so I have had a little bit of a concern that we've kind of got away from our raison d'etre here, right? We're the Real Advisor podcast. And we've been talking about funds and fees and the shit show that is the UK and PRSAs and blah, blah, blah. And we haven't actually been talking about our clients' goals, dreams, and aspirations. And what's our... You love Simon Sinek. What's our why? Why do we do what we do, Nick, right? Well, this is a brilliant short video. I don't know who Dr. Riley Moynes is. I have no idea how I found this, but I did find it on YouTube. It's the 4 phases of retirement, and it's really, really good if you have kind of bunch of clients who are preparing for retirement, right? I think it'd be really, really good to send to a couple who are preparing to go into their third act, as I call it. And he goes through these various phases. It's the vacation phase where you just go on holidays all the time, and then after a while you go, right, okay, we've enough of that shit now. Then you go loss and lost. So you feel a sense of loss, so your identity is lost, and you feel a bit lost in the world. You can't find your place in the world. You go into the next phase, which is trial and error. You try a few things. You might take up golf if you didn't golf. You might go sailing. You might, I don't know, do whatever. And you work out what's actually kind of working, what gives you a sense of purpose, what you would actually like to do over the long term. And then if you can move through all of these phases, he argues that the phase number 4 is where you start to reinvent and rewire your entire life. And if you can move through these phases and get to phase 4, he argues that they're the happiest people he's ever met. It's a brilliant short video.
I'm definitely going to watch that. Thank you.
He delivers it so well. He's in the phase 4 himself, so nothing like a guy with a bit of experience. He's made a few mistakes along the way. But yeah, that's what we're trying to create wealth for our client families so that they can go and live their dreams, their goals, their aspirations.
Excellent.
And we are probably not touching off that anymore. You want me to finish now, Nick?
I want you to finish, but I'm going to. If we ever get to the end of the agenda, I have a similar topical tidbit in a similar vein about that, which we will come to. Thank you, Carl,
That's
for
really
that.
good, Carl.
I'll
check
Nick,
that
I have
out.
another one on the agenda. Leave it out. It's a bit crap and boring, so leave my one out.
Is that the
You want to finish? You want to finish on a high?
The Goldman Sachs one?
Yeah.
Right, thanks.
Yeah, the
Okay,
Goldman
so
Sachs
quickly,
one, yeah.
very quickly for me, don't need to comment, but I mentioned in the last episode of the episode before that LifeQuote is closing down. This is where if you're an advisor that doesn't do much protection business, doesn't want to get involved with insurance companies, you could outsource it to a third party. Well, LifeQuote has shut their doors, no reason given. I asked on the IFA forum, tiny.cc/IFA forum, I asked on the IFA forum, about 700 members, I asked on there and said, is there a replacement? And
I'm
Mark
glad we had
Robinson-
time to put it in.
Mark Robinson kindly said, yes, there is another company. They're called essentialinsurance.co.uk. There's a link in the circle show notes. Check them out. They seem to be bona fide and on it. Okay. Capital Gain. Yeah, go on. Increase the agony, Andy.
Okay, this is the changing capital gains tax in the UK. The title is the article is entitled "The Wealth Raid Gamble That Isn't Paying Off." This is this whole Laffer curve. The more you tax, what's it called? Laffer curve.
Laffer went to work for Valley Path. Laffer is still with us.
The old Laffer curve. The more you
Not
tax
to be
people,
confused with the Laffer curve, entirely different curve.
is that
It sort of slopes upwards gently and then goes down.
I need to up
goes
my
downhill
skills
fast.
on the different curves.
Laffer.
The
Let's
Laffer curve, the more you tax people, the less you end up getting. So CGT has declined from the last reported numbers of 14.6 billion down to 12 billion. Yeah, incentives drives behaviour. It's like they model these situations without people changing their behaviour. Obviously, like we'll just continue doing this, and this is going to continue happening.
Yeah.
Obviously, that is not the case. They said the number of people that got caught by CGT and had to pay it did slightly increase. So there's only, or quite a lot of people. There's 378,000 people in the UK that paid CGT. That could be a tenner or 100 million, obviously, So quite a few people got caught up with it. So this is an ongoing thing. Obviously, we've got the exodus of millionaires, billionaires. London is falling apart, as we all know. Watch thefts, phone thefts, uproar, graffiti, £10 a pint. Things are not doing too well at the moment, and it's all just bad news on the horizon.
Well, we're always ahead of the curve, and then it'll go to other smaller islands to our.
We're going to hit rock bottom before the others. Yeah.
I would just quickly say on this capital gains tax. I'm sure you say that number of people incurring capital gains tax have gone up. I'm sure there are loads of Mrs. Miggins who don't even know now with the 3K limit they broached it, and I'm not sure how we're ever going to get through that morass. Because I'm not sure the platforms have reduced to tell HMRC. I'm not sure if they've got the systems to do it. So it's a shit show. They might as well get rid of the 3K.
Sounds awful. Sounds awful, lads.
It sounds awful, but the good thing is, mate, when it comes to you, we'll tell you how to get out of it because we'll be out of it by then. Okay, moving on. We're not going to do your Goldman Sachs report. Storyteller, an embarrassing cringe story.
Nick, can you put your hand down on the system there, please?
Oh my God, it's too complicated. I just want to.
Do you have to make a grovelling apology?
It's a bit of fun, Andy.
Okay.
Close personal friend of mine.
Does all the time.
Get it right this time.
Yeah, no, hang on a minute. What is it?
Yeah, you forgot it, didn't you?
I give a shout out to the guy. He's a big head honcho at Friends of the Podcast Vanguard.
Good friends.
And
very good
concentrate.
Yeah.
And his name is Doug Abbott.
Yay! Nailed it.
I don't know why. I had a bit of a brain freeze because I mentioned him last time in sort of glowing terms. Said Doug, because we met and we had a conversation about a bunch of things, and I called him Doug Bennett for some reason. I happened to be in the Vanguard office recently, and he was walking past, rushing to another meeting, and he said, "Oh, thanks for the shout out. Pity, but you got my name completely wrong." And now apparently he's known in the office as Doug Bennett. I'm really sorry, Doug Abbott. His name is Doug Abbott. He's a great guy, and he's a big
now
fan.
Known as DB.
Big fan of the pod. So apologies again, Doug.
But he was.
Hope to see you soon.
Okay.
Thank you.
Great stuff. Okay, we're almost there. Coming back to Roger's point earlier about how really we are lifestyle financial planners, and we shouldn't get enmeshed too much in the weeds of funds and fees and everything. So a great tweet from the US guy we really admire, Peter Maluk, and I think Storyteller, you have shown us this before. It's that little video of where you flick through a book of pre-written cartoons and it creates like a moving image. And this video is of a man. He's a baby, becomes a student, becomes a man, and then when he's an adult, he starts chasing money. And he goes going through his life, and by the end of his life, he's on the edge of this cliff with all this money. He's lost all his hair. He's always going to die. Sign behind him saying the end. And he's got all this money, and he hasn't done anything with it. Hasn't used that money to buy dreams and aspirations
What
and
happens
whatever.
when you lose all your hair?
Do you know what? That's well.
Well, I'm waiting for the regrow stuff to come. Andy,
You can't see his hair. He's wearing a teenager's cap.
I'm wearing a cap.
Ask Andy where he get that
That's
stuff
a glare
from.
thing. This will be only the end of my life, hopefully. But anyway, it's a brilliant. If I was rebuilding a website, I'd probably have that as my focal
Get personal,
thing.
Alan.
And just
That
do
is,
just do
it was
that.
Nick said it first. That was that's interesting. Yeah, that was my pinned tweet for about three
that's
years.
Alan's video. I thought you put that. I thought you created that, Alan.
It's a mystery because I've really tried hard to find out where. It's like Carl says. I don't know. Sometimes things just land, or you read it, or you.
Yeah.
And I had it, and I've searched online forever trying to find the source, and I hadn't found it.
No, it's brilliant.
A very quick side story about that exact short
10,
video.
9, 8.
You know him, and
7.
you know Adam. What's his Adam? He used to be in the IX group.
Bennett.
No, he was an IFA, and he was just
he quit his job after watching that video.
quit,
didn't he,
yeah.
Alan?
I posted that on LinkedIn a couple of years ago. He saw that, quit his job, moved to the States, now doing something completely different. And
He watched the
was
Dolphins,
homeless.
the Miami Dolphins of the NFL.
Yeah, that's
he
right.
was F1, then Miami Dolphins. All because of
he's,
you, Alan.
He's living a dream all down to me. Yet another one added to the list.
Just on that, Peter Maluk, he did another tweet that I thought you were going to link to, Nick. I know we haven't got time much because I don't know if Carl spoke about it. Long story short, he did a tweet because he's working with Charlie Bilello of Creative Planning. Nvidia now as one stock represents 8% of the S&P 500. It's the first time a stock has got to 8% representing one stock. Isn't it insane at 4.3 trillion? Carl, did you allude to this somewhere else?
It's
About
actually
Mag
in
7 and
that.
stuff?
It's in that Goldman Sachs report that I said skip over, but it'll be in the show
One
notes.
company, 8%. Have you
Yeah.
seen the turnover and profit of it is insane.
Yeah.
Andy,
Go on,
Andy,
Alan.
it's 3.5, over 3.5 times the entire FTSE 100. That one
Yes,
stock.
one company.
One company's
I
3.5
thought- yes,
times
one
the
company.
entire.
I thought it'd be much more.
Yeah.
Right.
No.
And by the way, do
the
check-
entire UK stock market, Alan, forget the
the
FTSE 100.
Irish,
FTSE
yeah.
100 makes up 90%. The other 10% is just a throwaway.
And it's as big. I think it's as big
one
as
company.
France.
All right, we're getting back into the weeds and shit and stuff. And next you'll be reading out which markets have done best over the last 6 months for 3 hours. Okay, so we're at...
It was Poland, wasn't it?
57 minutes in. Shoot me. Topical Titbits. We'll carry forward the Goldman Sachs one. We'll forget the Woodford Irish Times.
Yeah, forget it.
Okay, right. Let's move on then to the next part of the show, which many people do call the meat and potatoes. And our regulator in the UK, the FCA, Carl, what happens here can sometimes happen to you. So I hope you and your Irish listeners will take some value from this as well. Our regulator, the FCA, has done yet another review. This time it's into the retirement income advice landscape. I can't say it's extensive because given there are, God knows, X number of thousand IFAs in this country and hundreds of firms, they did this review on 28 firms. So I wouldn't say it's categorical, all-encompassing. But their retirement income advice review found three key areas. And some of it I agree with. Some I think, spot on. There's one area I think they're so spot out it makes everything else almost redundant. But let's look at the two positive things. So 3 key areas. Number 1, information collection and record keeping. That the FCA found good practice where IFAs had detailed information on all assets and income for both the client and their partner, as well as documenting clear retirement objectives. Now, to me, that's basic hygiene stuff. I mean, who wouldn't be doing that? And they said poor practice is where they have insufficient information on file, particularly regarding income and planned expenditure. And I'd be thinking, holy shit, you've got to be a really rubbish IFA if you're doing retirement income advice and you don't know the client's income and expenditure. So I don't know.
Where'd you start? You can't.
You can't. I know. I mean, poor practice. Yeah.
No,
No shit. Yeah.
Here's where you start. You go, I know the best pension fund.
Yeah.
Well, that's right, Carl. That may be what it is, but I'm amazed, and I'm hoping the FCA is going back to those firms that don't have sufficient income about clients' liabilities, income, and expenditure, saying, "Listen, Sonny Jim or Sonny Joanne, pull your knickers up or pants, depending on what gender you are.
Keep digging, man.
Come on, Nick. Come on.
And the other thing they talked about, which I kind of agree with, this is the third thing, I'll come back to the second in a minute, was sustainability of income withdrawals. Good practice, the FCA says, is using cash flow modelling to project the impact of withdrawals, considering all assets and stress testing scenarios. Again, to me, that's just like, holy crap, are people giving advice without using fit-for-purpose cash flow modelling?
Yes.
Basic hygiene.
Yes, they
basic
are.
hygiene.
Well, they obviously
Lots.
are. They obviously are in this 28-firm extensive review of the entire UK advice market, but it's just incredible. But again, poor practice was they're still using cash flow modelling without a clear rationale for the underlying assumptions and projecting income withdrawals that are clearly unsustainable. Which, okay, that I don't know, because I model things. I'm sure we all do. So I have loads of cash flows, loads of clients with live plans where we are having an unsustainable rate from a particular pot, because the idea is we're going to strip that pot down and then later on turn on the income, tap some other pots. But if they're saying here, no, the sustainable rates across a client's invested portfolios are, say, 8-9%, that's clearly unsustainable. But maybe there are underlying reasons for it. But I mean, you obviously wouldn't do that as your base plan as well. Where I think the FCA, and this is never the twain shall meet on, this is the second of the three outcomes they were looking at, client risk profiling. And once again, the FCA, I think, are looking at this through the wrong end of the telescope. All four of us, I will talk for all of us here, and most of the Trappists, the biggest risk for our clients is clients running out of money right before they run out of life. The FCA is focused on a entirely different kind of risk. Their definition of risk is volatility in investments.
Short-term
Volatility.
Downward volatility.
The FCA say that the good practice is using bespoke retirement-focused questionnaires, reviewing the assumptions behind risk profiling tools, and simulating market falls to assess the impact on client funds. Wrong. You don't change the risk assessment questionnaire just because a guy who was 59 yesterday or a girl who was 59 yesterday is now 60. They're still going to have 3 to 4 decades ahead of them. Risk tolerance tends to be immutable. It doesn't change over time. So why are we thinking that it's going to change? The FCA thinks people's risk tolerance, risk attitude changes. And again, marketing these declines as permanent losses, which is wrong, which is where this whole capacity for loss thing is so redundant and wrong. And now, compliance people out there will be screaming, well, that's fine, Nick, that's your view, but you've got to comply with what the FCA says. Yes, of course I do. I do it as much as I possibly can, but I do it through gritted teeth because I care about client outcomes. I really care about client outcomes. Not what you think they are in your ivory tower, but what they actually are, because these people pay my income. Right, they keep the roof over my head. So I am duty bound from a moral point of view to have client outcomes to the front and centre of everything. And this part of it is absolute rubbish. And the FCA then says area for improvement would be failing to reassess a client's attitude to risk and capacity for loss as they transition into decumulation. Again, a word nobody should use, especially when their circumstances change. Wrong. So for me, there's good and bad in that. Obviously, it reinforces what we do. We all do full fat financial planning. It's all based around a cash flow forecast. It's all about marrying the client's objectives and dreams with their assets. Okay, trying to get them there. The fact that some people aren't doing even that, I think, is frightening. But this risk profiling thing, honestly, I'm going to go to my grave batting this, and I think all three of you will as well. It's still a massive clash of tectonic plates as far as I'm concerned. But hey, good for the FCA for looking into this. Good in parts, bad in others. No hands are raised. Any thoughts?
Just very briefly, you said 28 firms. I knew a firm, and you guys know the firm. The clue is going to be JJ. So they were one of the 28 firms that got this survey.
JJ gets reviewed with everything.
You know who did the
first name
who did the survey.
Yeah.
And they're a cracking firm.
They are.
I'm amazed at 28, and they were on the 28 list.
Bloody
so sorry, that's a side point. Nick, you pretty much nailed it, but it is the meat and potato, so we might as well have a few more points in here. Yeah, I mean, risk profiling is misconception mirrors that I've spoken about. You call them mumbo jumbo questionnaires. It's this sort of false comfort. And the FCA, it's just the same pillars that they go back to: risk profiling, capacity for loss, which don't really work in the real world. We know that. They might work on a spreadsheet. Risk profiling tools, measures feelings, not facts. They're unreliable, outdated. The capacity for loss thing is so vague, and it just leads to excessive caution, poor decisions and outcomes, and it's this obsession with with risk, which leads clients to fear volatility rather than understand it. And there's no, retirement's not one-off. It's constantly evolving. It's a living strategy that we're always working with our clients. So again, guns are focused in the wrong direction. I think the regulation will be better focused on trying to get clients to understand, simplicity, long-term thinking, not just more and more layers of confusion. Well done for them to try and have a look at it. And they've mentioned some okay points, but real advisors, we're on the front line with all these clients retiring, and we're massively focused with real outcomes, better client outcomes, and we have to pander to the regulation, but at the same time, our ultimate duty is with the clients that we serve.
Very good point. Just quickly, Delaboche, before I come to you, the point you made there, Andy, is very well made. And even the FCA in recent months has made moves to saying we've got to educate people about the risk of having money in cash and so forth, as has Rachel Reeves, our current Chancellor. And they say that with one side of their mouth, and then come out with this on the other side of their mouth. So it's like these are massive buttressing tectonic plates that never the twain shall meet, and one's got to give over the other because we're going to go around in circles with this. Delaboche.
No, sorry. One more point. We've had real examples to test capacity for loss, and nothing's happened. COVID, the market went down by minus 35% in 30 days. Everyone's capacity loss, according to a survey, would have been tripped. Nothing happened. We had another one in April this year. The market went down by 19% in a week. Lots of capacity for losses would have been tripped. Nothing happened. Why do they never take a historical audit of history and then change their way that they think about these things? So we've had real examples where their theory has just been proved completely incorrect. Why do we not talk about it more? Carl, sorry.
I scanned the report. I think the report was shockingly amateur. I think I really do. I do.
He can say that from his ivory tower.
He can say that. They're not your regulator.
Yeah, no, I can, and I wouldn't be stupid enough to say that if it was the Central Bank of Ireland report, right? But it was like a teenage student's exam questions reply. It was so bad. Yeah, it was really bad.
So cool.
It was very short, so it was easy to scan.
It was, yeah.
And on the one hand, they're talking about, you must do cash flow modelling, and, you've got to get better and do it if you're not doing it. And then it goes on to the risk profile questionnaires. Now, look, we have to do risk profile questionnaires. We do them for every single client, and we're always going to tick that compliance box. We're not going to be idiots. But we've spoken about this a million times before, that if you're doing cash flow modelling, you always know what cash you need in the next 3 years. So, therefore, you are avoiding any issues that short-term volatility is going to bring. For the FCA to write a really short report, and these two to be 2 out of, I think, 3 points, they contradict each other entirely. So it's absolutely 100% demonstrating that the civil servants in their ivory towers do not understand what they're doing. And I look forward to applying for our British license.
No chance.
Joking. Well said.
Andy, you've got greater experience or exposure to lots of IFA firms. You do training for that's a sort of self-selecting audience you've got. But what's your estimate as a percentage of the total number? There's about 5,000 firms in the UK. How many, as a percentage, do full fat financial planning, detailed cash flow modelling using software for every client?
I would say there's 25,000 advisors just to do it like that, because that's easier on my brain. I would say probably 10% are doing it at a decent level. Then maybe another 10%. So 2,500 are doing it very well. Another 2,500 are dabbling.
Yeah.
So that's about 20%. I probably still think 50% don't do any form of it. I mean, they'll say we do a bit of it. We got a spreadsheet.
Yeah.
You have to use a tool that is fit for purpose. And I'm sorry, the only tool fit for purpose at the moment is the one that we all know. I'm not going to mention the name again, but it's called Voyant. There's a few that kick about. Anyway, that's it, Alan. That's it, Alan.
Don't tell me the
cash flow software providers
sorry,
exist.
the name is utterly irrelevant. I would use any system that was fit for purpose.
Right. So, but here's my point on this. You've said, and you do have a lot of knowledge about it, and at best, 80% of the market, or at worst, aren't using either nothing at all or are dabbling. And I've heard this
Why
before.
doesn't the regulator make it mandatory? That's where we're heading.
Thanks for putting your hand up every time one of these, because it's exactly my point. When you make this mandatory and you say, in order to answer all the questions that they have analyzed in this report, if you said that, and here's some core, of course you have to work out what their assets, liabilities, income, and expenditure are. You can't build a model without those things. So it's predicated on knowing that. You build a model, and it should be essential for everyone. And the vast majority, and my own experience, my anecdotal experience, and we recruit people, we hire people from firms that purport to do financial planning. When you speak to some of these people who are power planners, used to work at other firms, they say, not really. Sometimes, if a client asks for it, and no client ever asked for it. So that's the first thing.
But sorry, just on that, Alan, they are firms are introducing internal rules. Large networks are now requiring any retirement planning advice to have a cash flow. So it's not been mandated by the regulator, but probably about 40 or 50% of the market now, because they work for these firms that I know that are mandating it, are saying if you're doing any retirement income planning advice tax-free, you need to have a full cash flow.
Well, if I owned a network, I bloody well would want it mandatory for my advice.
Yes. So the large networks that we all know,
I wouldn't be able to sleep at night not thinking.
So it started with the DB work. They said if you do DB work, you have to do full cash flow. Then the second area of advice is now retirement income. It will only be a matter of time before every firm, every network, every support service says everyone who's doing retirement income advice needs to do a cash flow. And then it will get to the point of saying, if someone's paying you for ongoing advice, you need to do financial planning, full fat financial planning with them. We are getting there slowly. But, I've been in this business 15 years and I've been using Voyant 15 years. I thought surely everyone's going to be using it. And we're still at the point now where 50, 60, 70% of the people are not going to touch it. So anyway.
Carl, you were very patient there. Your hand was raised. You're taking it down. You got something to say?
Oh, I forgot.
Can I just add something else?
He answered my question, yeah. It was,
okay, let me just add something else which kind of relates somewhat to this paper that the regulators put out and this conversation. You guys familiar with an advisor in the US, posts quite a lot on LinkedIn, Eric Nelson, I think his name is. Servo, SERVO.
He's a massive DFA hardcore.
Yeah, big DFA advisor. But I like his posts. They're very thoughtful, and I would suggest that he shares broadly the same philosophy as we all do, and he questions risk profiling questionnaires and all that sort of stuff. But he posted something quite recently. I thought, that's interesting. In terms of this attitude to risk, how much can you afford to lose, all these ridiculous questions that we are compelled to ask our clients. He said, just in a conversation style with a client, how much future income in terms of by years do you wish to set aside in the event that we have 2008 all over again or anything else? How much income would you feel comfortable? Is it 2 years income, 3 years, 5 years? What do you feel? And I think that his average was about 3 to 5 years, was people would feel comfortable if there's a big market decline. Yep. And that drove their asset allocation.
I'm reading that post a few
because
weeks
if everything goes tits up and you've got 4 years worth of your next 4 years expenditure at your current rate, and as we've talked about in the past, lifestyle does change, and if we are having a sort of Armageddon period, and people will tighten their belt a bit and live, but just on your current normal level of expenditure, you got, let's say, whatever you feel comfortable with. I've got 4 to 5 years. That's in short dated bonds, and the rest is my fuel for my longer term. But I think that I really like that as a rule of thumb, at least to have a conversation with a client, as opposed to tick this box and I'll give you what the box says, even though you don't understand the questions in the first place. Absolute nonsense.
Well done.
Ultra?
Yeah, absolutely right, Alan. And you can tell a real advisor came to that conclusion.
Yeah, exactly.
Not the civil servants. A real advisor after 20, 30, 40 years in the business, pulling his hair out or whatever, and has got to the conclusion that the elegant, simplistic, best question to ask someone entering retirement is this one question, and then everything else can be built around it. So, yeah, great point.
Great stuff. Okay, we've given that. That was good. That was good meat and potatoes. We've given that damn good thrashing. We are at 74 minutes into episode 76 of the Real Advisor podcast. So I think, well, actually, I don't get to determine this because this next section is determined by when the postie is turning up on our front door. And there she is. She's hauling up the bulging sack of Trappist questions to the front of Lincoln Lodge. If you want to submit a question to the Trap Pack, please do so in the pinned tweet on X or the pinned X on tweet. There is a link, and you click on that and you deposit your question, and we do get to it. Today's question is from January this year. And let's see actually who this question is from. I've got to get my trusty letter envelope opener out. This is from a Peter Watts. His social handle, LinkedIn social handle is there, and that will be in the so-called show notes as well. Peter says, and he admits this is more of a rant than a question, but hey, obviously back in January, we must have been talking about the bane of our lives, lifestyling funds. And Peter says, oh my God, timely with discussion on lifestyling. Scottish Widows Pension Protector Fund, prime example, misleading name of a fund. They talk about greenwashing, but the regulator really needs to get a handle on poor and misleading naming of funds for the retail investor, the non-advisor customer. This Scottish Widows Fund is down in the last 4 months, 9%, and over 5 years, 32%. Wow, it really has protected those clients' money invested in this fund. Reason for me highlighting it is I recently met a client who wishes to retire and understand how the best way is to go around it. Guess what? Cash flow highlights a need to work for another 2 years. This fund, the Scottish Widows Fund, has 1.2 billion in it, 1% charge, and actively managed. I appreciate the fund's objective, which is about reducing annuity risk, but really, what is very interesting is that the FE risk score for this fund is 128 compared to the Vanguard Life Strategy, which is total equity, of 99. Over 5 years, the Vanguard equity is up 50% versus this Pension Protector Fund, which is down 32%. Sorry, I had to rant somewhere, and most likely you get a lot of these messages because it's so easy to come across dross like this. Yeah, well, you're preaching to the converted there, Peter, definitely. And we all know what happened with annuities, and index-linked annuities, especially 2 or 3 years ago. They fell off a cliff, and they still haven't really recovered. And it's these funds, they come from a time where people would generally annuitize in retirement, advise clients. I don't think it happens. It happens very rarely now that clients annuitize. So take it on board, guys. Quick comment on Peter's post.
It's about, last time I looked at the data, it's about 9% of people annuitize, usually small pots.
Yeah.
And they annuitize. So over 90% of the market doesn't do this activity for which these funds were designed for. Yet another example of what we've been saying, well, pretty much since we started this podcast, designed by people who don't sit in front of clients regularly. And it's a solution to a problem that doesn't really exist for the vast majority of clients and customers. So well said, Peter. Nothing else to add.
Ultra. Muted Ultra. Classic. Oh, I hope you're watching this on YouTube because Ultra's having a meltdown.
Let's hope it's.
No, you're muted in Riverside, mate. You're muted in Riverside, not on your.
By the way,
your microphone's got a cross through it, so you're muted on Riverside. So unmute on Riverside.
Oh.
And he's left the building. All right. Well, we're not going to hang around for him because
Can I just say, like, if anybody has any tech issues, Andy is like, "Oh my God, this is a disgrace."
I know.
So
he gets so frustrated.
Oh,
yeah, it's episode 76, dear Trappist. So hopefully you'll
see you next time. Oh, Andy.
Right, quickly, Ultra, anything to add?
Yes, can you hear me first and foremost? Yeah,
No.
Peter, thanks for sharing that. I've saved multiple clients 6 figures by turning off lifestyling. No, it's important. It's important. That's
Andy.
No. All good advisors have saved clients 6 figures by turning off lifestyling. Even more now if I look at these numbers that have come in recently. What I'm saying about that, that's why we don't charge per hour. Wisdom is not sold per hour. That's one question. That's one answer.
Yeah,
that's
well
6 figures sold.
Absolutely. Totally.
Wisdom is not sold per hour.
That's right.
So that's it.
That's right. Okay, great stuff. Thank you, Peter, for your rant. Got our juices flowing. Got Andy and our tears with the technology, which is always worth the price of admission. Okay, let's move on to what many people call culture corner. Okay.
I would like to point you to a new podcast called Mañana. And it has been created by a very experienced financial advisor called Roy McLaughlin. I've known Roy on and off for many, many years. It's been around the block, and he's really focused on, for most of his career, on protection, interestingly, life assurance protection, all that sort of thing. And he just launched a new podcast. And there's a bit of a link between all this because I listened to the podcast when I was on holiday and it was really, really good. And I actually, if you boys cast your minds back to the famous, or shall I say infamous, Hum Dublin, when was that? Well, it's a few years ago.
Carl knows the date, doesn't he? Carl, the date?
No, move on.
My therapist has blocked the
It was a cracking conference, people. Don't worry.
Great conference. So my award-winning talk, I think it was the best talk of the day. But I talked about the art of storytelling, and I actually used the story because Roy had told me this story, which was then covered on this podcast. And it's actually, joking aside, it's a really, really sad story because some of you guys will know or remember the Sky Sports journalist, reporter, Simon Thomas.
Yes.
Whose wife, very sadly, was diagnosed with cancer and was dead within 3 days. Unbelievable and a really tragic story. And the story that he and on this podcast, I think it's the first or second episode, because Roy is his financial advisor. And when he was giving advice, setting up life assurance products, etc., and Simon was the main breadwinner, obviously, and his wife was a stay-at-home wife, and they had a small child that they were bringing up. And he said, well, we don't need to cover Gemma, I think her name is. We don't need to cover her because she doesn't make the income. But Roy said, and he told the story about it because he had another client this happened to. He said, I really would encourage you to do so, to cover the spouse as well, even though the non-breadwinner. And then as it worked out, and she tragically did pass away, he was able to not worry about the finances because they could pay down their mortgage. They had enough money, and obviously he's freelancing doing Sky Sports. But he goes through the story again, and it's really quite a profound story. It's well worth listening to. Every now and again, we mention in this podcast the life assurance and protection and what have you, and listening to that story, reiterated by Simon, the guy who was obviously part of the entire thing. It was a salutary reminder. I think it's a really well done podcast. It was a really good interview. Of course, Simon's a broadcaster himself, so he's very good at sort of sharing stuff in a good and elegant way. So I would recommend you check out the podcast. And the other thing that is worth saying that they refer to as well, because when you have that mess and somebody passes away, particularly if it's very sudden, there is a lot of just paperwork, isn't there? Admin and stuff. You guys may well know this. I knew but forgot about it. This online service called Tell Us Once.
Yeah.
Heard of that? Yeah.
Yeah.
So if something happens to somebody passes away, rather than have to tell your 50 different agencies and companies and organizations and what have you, you go on that
cuts a lot of the mess
website,
out, yeah.
Tell Us Once, and you provide all the details, and at least it sort of reduces some of the admin burden. So it refers to that as well.
It's not called admin, Alan. It's called sadmin. When something bad happens and passes away, it's called sadmin.
Yeah, that's
true. It is true. It hits people hard. It's like, I'm sorry about your terrible news. Now you've got to do 4,000 things over the next 2 weeks and talk to hundreds of people in call centres that you don't know what's going on. Yeah,
anyway, it's a good podcast. It's called Manana on all podcast platforms.
Right, me next. Okay, so I want to give a shout out to this guy because he's got a startup podcast and he's struggling to get traction. His name is Pete Matthews. It's the Meaningless Money podcast. He's only on episode 583. He did one on family protection trusts involving McClure solicitors. McClure solicitors went belly up, and they were trustees on all these trusts they set up, and people are trying to unwind them. Family protection trusts, as far as and I'm not very good on. I find trusts give me the willies, right? Life assurance trusts, I'm happy with. Beyond that, they give me the bloody willies. These family protection trusts seem to be a way of trying to make sure the family home was outside of the estate for care home assessment. And they haven't worked. They've been a complete balls up, and now you've got loads of families. They can't sell these homes. That they can't, even when people have passed away, they can't sell them because they need the trustees' consent. The trustees aren't around, and well, obviously Pete's a pro at what he does, and he goes through this very well. He teases us out. He's interviewing a guy who's going through this with his own family. Well worth listening to. As a quick side note, on the IFA forum, china.cc/IFA forum, there are so many questions about trusts, bonds, and taxation. I would urge younger Trappists who are being encouraged by life assurance companies to think investment bonds are the panacea. Now the capital gains tax regime is less beneficent, just to go in with your eyes open in terms of setting up life assurance bonds and trusts, because you are stuck with that effing provider for the rest of your bloody days. Okay.
Oh my God, is it messy?
Right.
I've got two. Diary of a CEO, Stephen Bartlett. Haven't listened to him in a while, actually. Went kind of off him. I don't know why. But this one is an interview with Kevin O'Leary, who's
Shark Tank.
Shark Tank guy from the States, Dragon's Den guy. Absolutely brilliant. It's
Good, yeah.
really, really good. He kind of goes through what the traits of an entrepreneur are. So if you're embarking on wanting to be a business owner, you should listen to this. Talks about, he worked for Steve Jobs, right? And talks about the fact that he was a genius, but probably not a very nice guy. Talks about maybe what we would put in inverted commas wokeism, and talking about nice versus respect, and about hard work, and about work-life balance being bullshit if you're setting up a business. Kind of talking my language a little bit. And he has some very good investing advice, even though I wouldn't agree with it all. He was big on discipline and, putting money away. And then he speaks, Alan, you'd love it, about the power of AI, which I think I'm pretty much sold on at this stage. So really, really, really good. A really interesting guy, and well able to tell his own story. And then the second one, this one, because I don't look at the show notes ever, so I'm not sure, has this one come up? Hot Money, Agent of Chaos.
I love Hot Money. This has got 3 series. This is the third one. Yeah,
This is the Wire card.
Yeah,
right?
the American, the
FT.
German company. Yeah, it's mad.
Wirecard, Jan Marsalek, right?
Yeah.
Guys,
Is this the FT thing?
Yeah,
That's been out for a while, isn't it?
It is absolutely.
Yeah, I watched it.
It's like a James Bond story in your ears. It is wild.
They still haven't caught that guy.
Okay, I'm going to subscribe.
No, it's one of them living in China.
Thank you
or
for that,
something.
Carl.
Belarus, I reckon he's in now at the
yeah.
moment. Yeah, somewhere like that.
Wow.
It is absolutely amazing, and it happened on your doorstep. It happened in London.
Yeah, it's good.
And like he had anyway, I won't ruin it. It is amazing. Like a brilliant podcast series to listen to over the summer. Just amazing. Really,
And the
really
previous Hot Moneys, I think one of them was about the porn industry. Sounds better than it is. And the other one was about crypto and Angel Coin. So yeah, Hot Money is an awesome.
I saw that
podcast
one, the Angel
series.
Coin one. That was
yeah,
nice.
the Angel Coin one. There's some great
Is it
ones.
Hot Money or Agent of Chaos that I should be searching for?
Hot Money.
Hot Money
Okay, got it.
series.
Thank you. I'll definitely subscribe to that now, Carl, on Pocket Cast, and download every season 3
if you
episode
just went
8.
into the show notes, you could just click on the link that I put in. But anyway, not to
Yeah, show notes are just on the website now. I've done that while we were speaking.
Show notes not as good as us. Remember, our show notes in one magnificent document that's going to be the mother lode, the Wikipedia of UK financial services needs to come. Okay, listen, I think we are... And Andy, sorry, mate, cut you off.
That's fine. Mine is a Netflix docu-series called American Manhunt. Osama bin Laden. Do watch it. It's full of a lot of interesting stories, obviously historical perspective, but it's how the Americans reacted to it. They were just hell-bent on getting Osama bin Laden, regardless of the collateral damage and just the whole mess that they were creating. So it's a good insight into the human psyche and human nature. But yeah, check it out.
There's a brilliant movie on that, isn't there? It's kind of a docu-movie, if that's the word.
That's it. This is it, isn't it?
Oh, that's it, is it?
I
thought Andy said it was a series, no?
Well, it's three episodes. I don't know if it's new. It is new. Yeah, 2025.
It's brand new. Nick's friend, Chamath, probably put the kettle on. He was talking about it at an all-in thing a little while ago.
It's decent.
So it's really good. Yeah.
Okay.
A bit
Yeah,
rogue.
there's a movie as well you'd love if you like that. That's absolutely brilliant. Yeah,
I'll check it out. Thank you.
Good stuff. Good stuff. That was a really good episode, guys. Thank you for that. So we're at 80. We're in the 88th minute. God help us. So, dear Trappists, there you go. Episode 76 has come to a close and is sliding down the U-bend of Father Time. Thank you for your precious time. Please do leave a review. 6 out of 5 stars on your app of choice. Keep them coming in. Keep the questions coming in. We're only as good as you guys, really, and girls, really. So let's keep on building this out. Subscribe to our YouTube channel. Well over 1,000 subscribers now. Going great guns on that. But until the next time, from the Trap Pack, Trappist, it's adios. Take care out there, and we'll see you in episode 77.
where we might have a guest.
Oh yeah.
I'll be in Spain.
See ya. Not too bad.
Is that outfit AI, Nick, or real?
Cretin.
Thinking of a reply.